Imagine logging into your exchange account or checking your wallet only to find your crypto balance is zero. Gone. The feeling is devastating. Beyond the immediate financial shock, you're probably asking, what about my taxes? Can you deduct that loss? The answer is yes sometimes, but it's incredibly complex. In this video, we'll cut through the confusion. You'll learn the crucial difference between a capital loss and a theft loss, how the IRS views lost crypto, and the strict conditions you must meet to claim a tax deduction for your stolen digital assets. Crypto security breaches are unfortunately common, and they highlight just how vulnerable both individuals and companies are. We've seen major incidents, like the reported Fat Finger incident, which reportedly led to the mistaken transfer of millions in Bitcoin. Bitcoin Depot's reported security breach, resulting in approximately a $3.7 million loss. These aren't just headlines, they're real financial disasters. When your crypto vanishes, recovery is the first thought, but understanding the tax implications quickly becomes just as critical. This isn't a niche concern anymore. It's essential financial knowledge for anyone holding digital assets. The foundation of all U.S. crypto tax law is this. The IRS treats digital assets as property, not currency. 2, this means your Bitcoin or any other cryptocurrency is taxed like a stock, a bond, or even real estate. 2, this classification has huge consequences. Every time you sell crypto for cash, swap one coin for another, or even use it to buy something, it's a potentially taxable event. You have to calculate a capital gain or loss by subtracting your cost basis, what you paid for it, from the proceeds. This property treatment is precisely why dealing with stolen or lost crypto is so complicated. You can't just write off the dollar value that disappeared like you might with physical stolen cash. You have to follow the IRS rules for losses on property. Here's the golden rule for claiming any tax loss. You need a closed and completed transaction. This means you can't claim a loss just because your portfolio dropped in value or your assets are temporarily inaccessible. For example, if the price of your Bitcoin goes down, that's an unrealized loss. You can't claim it until you actually sell or exchange that Bitcoin. The same goes for frozen accounts. If your crypto is locked up on a bankrupt exchange like FTX or Celsius, you don't have a closed transaction yet. You can't claim a loss while those assets are still tied up in bankruptcy proceedings. A deductible loss only happens once the bankruptcy is finalized and you know exactly what, if anything, you'll recover. However, an outright theft can sometimes qualify as a closed and completed transaction, potentially opening the door to a deduction. When your crypto is definitively gone, the loss typically falls into one of two categories for tax purposes, a capital loss or a theft loss. The distinction is critical because they have very different rules. A capital loss occurs when you sell an asset for less than you paid for it. You report this on Form 8949 and Schedule D4. Capital losses can offset capital gains, and if you have excess, you can offset up to $3,000 of ordinary income per year. 3, a theft loss, on the other hand, is when your property is illegally taken, like in a hack or a scam. This is reported on Form 4684. 5, traditionally, theft losses could be deducted in full in the year you discovered them, without that $3,000 limit. But here's the catch. Recent changes have made theft losses much harder to claim for crypto investors. This is the deduction everyone wants after a hack, but it's the hardest to get. The rules are in IRC Section 165 and IRS Publication 547. 6. The biggest hurdle is the Tax Cuts and Jobs Act, or for tax years 2018 through 2025, they suspended the deduction for personal casualty and theft losses. 7. This means if your stolen crypto was considered personal use property, say, you used it for occasional purchases or as a hobby, you likely can't claim a deduction. The IRS only allows these personal losses if they're from a federally declared disaster, which a crypto hack typically isn't. This change made it much tougher for the average crypto holder to deduct stolen assets. There's a crucial exception that most crypto investors will need to rely on. The suspension doesn't apply to losses on property held for a transaction entered into for profit. This means if you held your crypto purely as an investment, with the clear intent to make money, a theft loss might still be deductible. To qualify, you need to meet 3 strict conditions. First, the taking must be illegal under state law, like a hack or a pig butchering scam. Second, you must discover the loss in the year you claim the deduction. And third, and often the hardest, you must prove there's no reasonable prospect of recovery. This means no realistic chance of getting your crypto back through insurance or legal action. For scams involving anonymous, overseas actors, this might be easier to prove than if your crypto was stolen from a regulated U.S. exchange. If a theft loss deduction isn't possible, can you claim a capital loss instead? Only in very specific situations. One is if a token you invested in becomes completely worthless. This means the project is abandoned and its value goes to zero permanently. The IRS requires it to be truly worthless, not just trading for a fraction of a cent. You typically need an identifiable event, like the company's liquidation, to declare worthlessness. Another common scenario is losing your private keys or a hardware wallet. This is generally not a deductible loss. Why? Because you haven't sold, exchanged, or had the asset stolen. You've just lost access. The crypto still exists on the blockchain, you just can't control it. Since there's no closed and completed transaction, the IRS doesn't permit a loss deduction. Navigating these complex rules for lost or stolen crypto can be incredibly stressful, especially when you're already dealing with a financial loss. This is where a robust crypto tax platform like dTax can be a lifesaver. dTax helps you track all your transactions across 22 different blockchains product facts and multiple exchanges. It supports 13 different cost basis methods product facts, which is crucial for accurately calculating gains and losses. If you're dealing with a potential audit, dTax's pre-audit sandbox product facts can scan for common IRS audit risk categories, giving you peace of mind. It also generates an audit defense PDF with on-chain provenance for every transaction. This level of detail is exactly what you need to back up any loss claims. Check out .com. It's open source and free to start. Let's answer a couple of common questions. First, can I deduct crypto lost in a rug pull? A rug pull, where developers abandon a project and steal investor funds, would generally fall under the transaction entered into for profit exception for a theft loss. You need to prove it was an illegal taking and that there's no reasonable prospect of recovery. Second, what if an exchange collapses and my crypto is gone? If an exchange collapses and your assets are tied up in bankruptcy, you typically can't claim a deduction until the bankruptcy proceedings are finalized. This is because it's not a closed and completed transaction yet. You need to know the exact value of what you will or won't recover. It's a waiting game, unfortunately. Dealing with stolen crypto is a nightmare, but understanding the tax rules can prevent it from becoming a double nightmare. Remember, documentation is key, and proving your intent to profit is crucial for any theft loss deduction. Don't let fear or confusion keep you from potentially saving thousands on your taxes. Stay informed, stay secure, and protect your digital assets. Thanks for watching. See you in the next one.